We then moved into the second phase of the crisis, which is really the reverse of what we've just seen. From 2007 onwards, the monetary authorities decide to lurch from money being too easy and interest rates being too low to money being too tight and interest rates being too high. And so we had a long period lasting unbelievably through until almost the end of 2008, long after it was obvious that there were banks in deep distress, of them raising or keeping rates too high and keeping the money markets completely starved of cash at crucial times. Some of us were warning in July and August of 2007 that rates were already too high and money markets were already too short of money, and that they needed to make some more money available to the system to avoid disaster. They didn't listen. Instead, as August moved into September, the two most senior officials, the elected official, the Chancellor of the Exchequer, and the unelected official, the Governor of the Bank of England, decided to make speeches saying that some banks had behaved rashly, that it might mean they got into difficulties and it served them right, and that they should understand there were going to be absolutely no bailouts, that it was just a minor banking problem and they had to sort it out amongst themselves. I remember blogging on johnredwood.com on the morning of the Chancellor's speech along these lines, saying this was the worst speech I've ever heard any Chancellor ever give. The man clearly doesn't understand how desperate the situation is. He's going to have to change this policy. And if they continue to starve the money markets of funds in the way they are doing, they're going to have a serious problem on their hands. 48 hours later, the run on Northern Rock started, and with it, of course, came the very rapid and humiliating U-turn by Chancellor and Governor, who then decided that they would go to the support of a bank in trouble after all, because it would have been very inconvenient politically and economically if Northern Rock had gone under and not been able to pay out its depositors, who then wanted their money back. And so we saw the start of a new policy of selective bank support by taxpayers, beginning with the Northern Rock problem. But from the date when they recognized the need to rescue Northern Rock through to the date of the big crisis involving RBS and HBOS, more than a year elapses, and they did nothing to fix it. And some of us were saying to them throughout that period, if you think Northern Rock is the end of this problem, I'm afraid you're wrong. This problem doesn't just affect a medium-sized bank like Northern Rock, which, with a struggle, British taxpayers can support. It affects far bigger banks, banks bigger than the national income of the country, where a policy of intervention and subsidy and equity purchasing will be very expensive and could prove to be very damaging to the public finances. So in that period, some of us were saying, you should not go the nationalisation route. You should not believe that it's just Northern Rock and a few problems at Alliance and Leicester and Bradford and Bingley, that you need to look at the big banks as well, and you should in private be working with those banks to see how they can have a solvent and liquid future without panicking markets. You should always do it in private, in my view, as a regulator, because as soon as the regulator starts to question either the solvency or the liquidity of a bank under its tutelage, there is likely to be a run on that institution, because people will think, well, if the regulators are that worried that they're now making public noises, why should I keep my money at risk with that institution? And what you feared might happen will happen very quickly if you do it all in public. So we had this phony period between the run on the rock and the crisis a little over a year later, when the authorities try to believe there's nothing really wrong. They do change their monetary policy a bit. Having starved the markets of cash in the run-up to the rock crash, they then put enough money in the new year, 2008, such that if they'd put that amount available in August, Northern Rock wouldn't have gone down. There was quite enough money to solve a problem like Northern Rock. But they didn't put enough money into the markets in 2008 to solve the problem they were going to help create with RBS and HBOS, which duly turned around to bite them much later that year. So the second phase of the crisis is ultra-tight money, inability to read the money markets, lurching from too little to putting little bits in and then lurching back again to being too tight, hoping that the banking crash visible in the mortgage banks was not going to spread to the bigger banks, and saying that they were going to fix the regulatory system for the next time, and pretending that that was really the answer to the crisis. They didn't seem to realize that they should still be engaged very heavily in crisis management, because they were probably not even at the halfway point of this crisis when they were so complacent in the early months of 2008. The tragic self-inflicted events at the end of 2008 came together very quickly. Now, of course, it wasn't just a British crisis. The Americans had done something very similar. But I don't think the British crisis resulted from the American crisis. There was a British crisis of British banks regulated in Britain by British regulators, lending British money to British people and companies. And there was a separate but family-related American crisis of American banks lending American money to American people and companies under American regulators. But we know that they weren't dependent on each other, because there are other banking systems around the world that had lots of transactions with America as well that did not come under the kind of duress and stress that the British banking system came under. Lehman's was a challenge for everyone. There will be long arguments about whether it was a disaster to let Lehman's go down because the markets were really terrified and it was bad news while they're trying to sort it out, or whether people take the view in due course that it was actually the quickest way of resolving the Lehman's crisis, and they now have a profitable bank again trading under different ownership. But in Britain, we could have handled Lehman's, we could have handled the washback from America if we'd pursued a sensible policy towards RBS and HBOS, in my view. So what were they doing wrong towards the end of 2008? Well, first of all, they should not have had a public conversation with the banks about their liquidity and solvency. They should have been having private conversations with the banks about liquidity and solvency from August 2007 at the latest, when it was publicly obvious to some of us that we were in trouble. And they should have been well advanced in solving that problem by the autumn and winter of 2008 if they'd had sensible private conversations. What should you do with a bank that is short of either cash or capital or both? Well, you get it to sell assets. You get it to cut its costs. You get it to reduce the phenomenal pay it's paying its senior employees until it's profitable again. You make all its bonuses be dependent on future cash flows, not upon past cash flows and subsidies. You make it organize its business in a different way. You make it borrow from the markets long term. You make it raise new share capital if it has that option available. And in 2007, all those banks had the option of going to the market to raise share capital. If the regulator had told them then to do it privately, they could have done it. And we wouldn't have had the kind of problem we had at the end of 2008. So they failed to do that. Worse still, they suspended good competition law and encouraged the merger of Lloyds-HBOS. So instead of us just having an HBOS problem, which was a bit more manageable, we had a Lloyds-HBOS problem, which was going to be a lot bigger. If you take an all-right bank and add in a weak bank, you don't get a strong bank. You get a weak bank. And that's unfortunately what they discovered. So we then had to subsidize on their policy the bigger bank in order to subsidize the smaller bank it had acquired with a view to propping it up.